The most common definition of the insurance protection gap is to look at it as the share of uninsured losses in total economic losses. This approach makes a lot of sense when we talk about natural hazards. This measure is relatively easy to quantify, but it is based on a simplifying assumption. And this assumption is that all losses should be insured with no deductibles and no retentions whatsoever. In developing countries, this insurance protection gap and the property protection gap in particular can reach up to 100%, which means that virtually all economic losses remain uninsured for major perils such as storms, floods and earthquakes. But there are other areas as well where we are witnessing major protection gaps, healthcare for example. Take a country like India where 60% of all healthcare costs are funded individually out of pocket by individuals. And of course this burden can throw entire families into poverty if calamity strikes. And unfortunately at this point in time, prepaid insurance-based solutions play a very marginal role, only at a share of less than 5% of India's total healthcare expenses. Well, first of all, there are rational economic reasons for not fully insuring. A certain degree of risk retention makes perfect sense for both individuals and for society at large. Having skin in the game provides incentives for risk-conscious behavior, so that's in the interest of everyone. In addition, certain risks are and will always remain underinsured or even uninsured because the fundamental prerequisites to insurability are not met. For example, if events cannot be quantified in their severity or frequently within reasonable confidence limits, insurance markets tend to fail. The third reason is affordability. Think of developing countries, low levels of income, low levels of risk awareness. 60% of the world's population live on less than $10 a day, so lack of affordability is a very important factor to consider when we discuss the root causes of underinsurance. And last but not least, and that's a very important point to make, the protection gap debate is not limited to developing countries. In mature markets as well, we are observing major gaps in risk protection. Take term life insurance as an example. In a country like the United States, there is a massive mortality protection gap, even though term life insurance is a product that is not expensive at all. So affordability is not the issue. And most people would attribute protection gaps in more mature markets to things like excessive product complexity or a lack of customer centricity. The global insurance protection gap leads to a massive lack of societal resilience, in particular in developing countries where insurance, as of today, hardly plays any role when it comes to mitigating the impacts of natural disasters or pandemics, for example. And as I said before, the insurance protection gap can easily reach 100%, so all losses remain uninsured. And against this backdrop, fragile public budgets, fragile public finances are highly vulnerable to calamity. More generally speaking, insurance has an important role to play in facilitating and protecting the emancipation of people from poverty. External shocks such as disasters, sickness, accidents can obviously perpetuate poverty or can throw those back into poverty who have just successfully escaped from it. Against this backdrop, insurance can and has to offer a safety net. And last but not least, insurers work towards closing and narrowing the protection gap because they want to demonstrate even more credibly to their stakeholders that insurance has a very strong and compelling economic and social purpose and utility. Our report very clearly demonstrates that technology, and in particular digitization, is a powerful lever for insurers to come up with even more efficient, more appealing, more customer-centric products and solution. And in combination with enhanced value propositions, digitization and technology in general has the potential to reshape the way insurance is perceived as far as its role, its benefits, its nature are concerned. So ultimately, risk transfer and risk management as fundamental concepts could become more relevant than ever. Having said this, our study also shows very clearly that technology is already making significant contributions to narrowing protection gaps as we speak. So it's not just about future prospects, it's also about today's realities. So we shed light on a number of case studies, for example, showing how parametric or index-based techniques can be harnessed to offer climate insurance, in particular to the poor, or how mobile technology can be employed to distribute microinsurance. So the beauty about these success stories is that they have brought insurance cover based on technology. They have brought insurance cover to tens of millions of people who never used insurance before.